In the last class, we discussed profit and loss account. You remember that? We spoke about revenues minus cost of goods sold gives us gross profit, minus operating expenses gives us EBIT, minus interest gives us PBT, minus tax gives us PAT. That is what we remember, right? And then we saw the various classifications of that. So, today we will discuss briefly about balance sheet, and then we will move to recording of transactions, right. So, balance sheet lists assets, liabilities and capital separately, grouped into subgroups and listed in the order of their liquidity or length of time required for conversion into cash. So, it can be either in ascending order of liquidity or in descending order of liquidity, and listed usually in the either ascending or descending. It is prepared at the end of the specific period called as financial year. I mean, it is anyways prepared every month, right. For big companies, it is prepared every month, every quarter is anyways audited, right, for big companies, listed companies, and then every 6 months and every 12 months again you prepare properly and get it audited, right. So, this period can be called as accounting period, fiscal year, financial year. Now, let us look at one of the balance sheets in the next slide. So, this is the horizontal format. This is the case of Ramson's from your book. One of the book has the Ramson's case. So, if you see on this side we have assets, it can actually assets can be on that side also, and liabilities and equities on the other side. So, on one side we have assets, and this is the US book, na? So, that is the reason they have put it here. In India, when we do it like that, we put assets on this side and liabilities and equity on this side. And this is the horizontal format. There is another format called as vertical format. Let us look at the horizontal format first. So, if we look at current assets, we have cash. How long? Cash is anyways cash. It does not require any time to convert it into cash, right. Marketable securities are securities that can readily be converted into cash soon enough, right. There is no definition of soon, but if you are holding a share of say Reliance, say, and your intention is to hold it for a short term, right, then if you are in need of money, you can sell it today. Within 2 days you will get your money. Are you seeing? So, marketable securities you can sell and get your money within days, couple of days, that is all how much time it takes. Bills receivable. Bills receivable are promise to pay or promise. So, if I have sold goods to him, he owes me money, that is called accounts receivable. But if he owes me money for some other reason and he issues me a note which is called bill of exchange. So, when he issues me, for me it is a bills receivable, for him it is bills payable, right. And what does that note say? What is your name? Mohan. Mohit. So, Mohit, basically it is a note which says I promise to pay either me or the bearer of this bill of exchange 5,000 rupees, right, after 2 months, So, this is a promise on his behalf. This is called as a negotiable instrument, which I will anyways retain with me and submit it to him after 2 months. Okay, look at this bill of exchange, please pay my 5,000 rupees. Let us say after 2 months I have to pay to, what was your name? Rajarshi. I have to pay to Rajarshi exactly after 2 months another 5,000 rupees, right. So, what I can also do is endorse it. I can get that bill of exchange endorsed and say, okay, instead of I collecting from him the money, I just give it to you because you are asking me for 5,000 rupees. I said that I do not have 5,000 rupees in my pocket, but take this bill of exchange, and then I have already settled your liability, and then you have to go and collect it from him, Mohit. Are we clear on what will happen? So, this is how it works. Trade receivables, when you sell goods on credit, if you sell goods on cash, you receive cash, but when you sell goods on credit, what happens is somebody owes you money to whom you have sold the goods. So, that person is your sundry debtor, that person is called your debtor, which is also called as accounts receivable or trade receivable. The other name for debtor is accounts receivable or trade receivable. So, we will show our trade receivable under, because this will also be converted into cash soon enough as part of the operating cycle. You remember the operating cycle concept we discussed, that when we sell, the credit sales get converted into accounts receivable or trade receivable, and then, so when you sell goods on credit, then we have accounts receivable or trade receivable or sundry debtors, right. So, in such cases, of course, it will appear as in the asset side, current assets. Current assets we already know, right. We do not have to define it again, right. So, in addition to that, from past experience, we also know that some part of trade receivables will not be collected. Here it is clearly shown as high, is shown as 100 out of 1000, but in normal course of business you can say maybe 1%, yeah, or even less. So, estimated loss on collection is also called as provision for bad debts, right. So, you create a provision which is called as provision for bad debts. So, and that is reduced from the trade receivables. Then we have prepaid expenses. You may remember we mentioned about prepaid insurance the last time. Do you remember in the previous session? We said if the insurance premium paid is 12,000, on 1st of April you have paid 12,000 for one full year. So, every month you would have utilized 1/12 of it. So, you would have utilized every month 1,000, and on 30th of April how much of prepaid insurance is left? 11,000. So, the prepaid expense 11,000 will appear in the balance sheet, and 1,000 of insurance expense will go to the PL account of that month. We all know that, right? Everyone clear on that? So, this prepaid expense is that part. The expired portion of insurance goes to profit and loss account. The unexpired portion of insurance goes to balance sheet as asset, current asset. Inventory, we already know inventory. If you are a manufacturing company versus if you are a trading company. If you are a trader, we said all that you do is buy pants and shirts from market and you sell it, right. So, if you are a trader, you will only have, that pants and shirts as your stock, right, whatever you are trading. Trader means जो खरीदा वही बेच दिया, no processing done. But if you are a manufacturer, then what will happen is you will buy plain clothes from Raymond's and Aditya Birla Group, and then you will stitch them into pants and shirts, and then you will sell them, right. So, you will have three types of inventory with you if you are a manufacturer. One is the stock of plain clothes lying with you which you bought from Raymond's and Aditya Birla Group, that is your raw materials. There are some semi-stitched pants and shirts not fully done. There are some semi-stitched pants and shirts not fully done, which are called as your work in progress, and there are all the ready pants and shirts which are ready to be sold, that is called as your finished goods. So, we have three types of inventories: raw materials, work in progress and finished goods. So, this was about the current assets. Current assets are assets that can be converted into cash within 12 months or within the operating cycle of the business, right. Then we have non-current assets or fixed assets. So, under fixed assets we have land. How much of land is depreciated every year? 0. Then we have buildings, plant and machinery. In building, plant and machinery, we provide for depreciation. In building, plant and machinery, if you remember, we gave the example of a car that we bought. The car has a useful life of 10 years, value of the car is 10 lakhs, and then we said, we gave multiple examples, but the simplest example was this, that every year we will depreciate 1 lakh and value of the car will at the beginning of the year. If this is your balance sheet, at the beginning of the year you have just bought a car, What is the value of car appearing in the books? You have just bought a car. What is the value? 10 lakhs. 10 lakhs. After 1 year, how will the car look like after 1 year? 9 lakhs, that's correct. So it will look like car, original cost 10 lakhs less depreciation or accumulated depreciation. Okay, accumulated depreciation in the first year is same as depreciation because 1 साल का ही depreciation हुआ है, but from second year onwards accumulated depreciation will be 2 lakhs, then third year 3 lakhs, fourth year 4 lakhs and so on. So that's how you will provide. So it's called as gross block. This part, the gross value 10 lakhs will be called as gross block or gross fixed assets less accumulated depreciation, which is then becomes gross minus accumulated depreciation becomes net block or net fixed assets. That's how you will report it in the balance sheet. If the price, the question is, if the price of land increases, then shall we show it as appreciation, right? If you remember lecture 2, let's go back to lecture 2. We had discussed a principle, the historical cost principle. Do you remember the historical cost principle? And while explaining the historical cost principle, jointly with the going concern concept, what was the going concern concept? A business will continue to exist forever. It will continue to exist for thousands of years. Did we play a song to remind what is a going concern concept? What was the song? We said, तुम जियो हजारों साल, साल के दिन हो 50,000. Do you remember that? And so a business will continue to live forever. And we said, if a business will continue to live forever, then while recording the value of land, shall we record it at its cost or shall we record it depending on fluctuations in the market? Are you getting what I am saying? So we use the mixture of going concern concept and the historical cost principle to justify going concern, because since the business will continue forever and since historical cost says assets should be recorded at their cost, right? Therefore, we will record land at cost and we will not usually revalue it. We will not usually revalue it because then you will you keep revaluing it every year depending on how, and that is first reason. Do you get what I am saying? It keeps moving up and down. The second reason is, do you remember we also spoke about the conservatism principle, that accountants are conservative people and they will not, what will the accountants do as conservative people? They will account for all possible expenses and losses, but they will not account or record gains till we actually have them in our pocket. For an unsold land, even if the value has gone up, have we realized the gain? We have not realized the gain. So when we again consider, do you see that all principles are interrelated? The same question I am answering using multiple principles. Are you seeing that part also? So accountants, being conservative people, will not record unrealized gains. Of course, if there is a realized gain, then you have to show it. What is the difference between realized and unrealized? Paper gain is unrealized gain. कि हाँ market के दाम बढ़े हुए हैं लेकिन I don't have any money in my pocket. I bought a land for 1 lakh rupees. Today it is worth 100 crores. But I still have the land, I don't have 100 crores in my pocket. So this is totally an unrealized land. Unrealized gain. Realized gain is I actually sell it, get 100 crores and my bank balance shows 100 crores. So that, I will wear a tie also then, right? So that's, you have understood, have I answered your question? And you see that using multiple principles and multiple reasons, land should not be revalued. What is intangible asset? What did I say regarding intangible assets? हाँ, I know I said that. मैं स्टाइल में सारे काम करता हूँ. हे भगवान, मैं सारे काम स्टाइल में करता हूँ कि नहीं करता हूँ? तो बोलो कि मेरे पास माँ है, right? That's what I said. What did I say? अमिताभ बच्चन इज सेइंग मेरे पास गाड़ी है, बंगला है, बैंक बैलेंस है, प्रॉपर्टी है, गोडाउन है, फैक्ट्री है, तेरे पास क्या है, राइट? सो अमिताभ बच्चन साइटेड 7 or 8 टेंजिबल एसेट्स एंड ही साइटेड मेरे पास माँ है, एंड माँ पर से can be seen in test, but the love and affection of a mother, when he says I have mother's love, affection and blessings, that's what he was saying, right? And that is an intangible asset, right? Do you remember that? So what are intangible assets? Goodwill, so we talked about copyrights, patents, intellectual property rights, and do you remember we also spoke about, so that was one part of the difference. Second thing we mentioned was tangible assets are depreciated, and the same process of allocating the cost in case of intangible assets is called amortization, right? And tangible assets may be depreciated over a long period of time. For example, this building that we are in, it will be depreciated over 50 years. The land will not be depreciated, because once you construct a building, you will use it over many years. So, there might be minor repairs and maintenance, but the broad structure of the building will be in existence for 50 years, God willing, right? So, the building will be depreciated over 50 years means 2% per year, right? But when it comes to amortizing intangible assets, we will not amortize it over 10 years or 50 years. Will we amortize it over a short period, or will we amortize it over a long period? Short period. You remember that, right? Because even if you have come up with a new technology, you never know, someday Yashashvi comes up with another technology and your technology becomes useless, right? We see that every day, right? The mobile phone has put watch, cameras, everything, all those industries are suffering badly only because everything you can do with your mobile phone. So, mobile phone industry is prospering, but all other industries like watch, calculator, who uses a calculator these days? Because either if you are using your laptop, you use Microsoft Excel, for example, or even if you are using your mobile phone also has a calculator inbuilt. So, you can just go to calculator and use it. So, nobody is using a calculator, right? Nobody is using a watch, very few people are. Very few people are using a separate camera, right? Because if you want to take a picture, we just take out our mobile phone and take a picture or video record anything. Do you see that? So, which technology will make which technology outdated? Nobody knows. So, we amortize the intangible assets very, very fast. So, for example, we will amortize not over 10 years, but just 2-3 years, maybe 3 years, one third, topic closed. Deferred expenditure, there is a slide on it, but to put it briefly, it is coming up. Who was the person who took loan from somebody else on day one? Rahul. And you took from other Rahul. So Rahul you gave. To whom did you give? To the other Rahul. Where is the second Rahul? Yeah, second Rahul. So you gave 1 lakh to him? Yeah? Because he had only 10 rupees in his pocket, I remember. So you gave 1 lakh to him so that he can run his business, right? And what were your concerns then? He will give the money back or not, right? So let us say you got 10 crore loan. Okay, now hold on. Who has 10 crores in this room? I have 10 crores. Okay, fine. Thank you for believing that, yeah. So okay, let's assume I have 10 crores, right? He comes, Rahul comes. Which Rahul? You took the loan. No, you gave the loan. So you came. So he comes. Okay, forget him. What can I do with my 10 crores? If I am a risk averse person, I will just put it in fixed deposit and at 7.5% per annum, right? Let us say Mr. Mukesh Ambani comes. Yeah, I need 10 crore. I know he doesn't need 10 crore from me, but let us assume Mr. Mukesh Ambani comes. He says, I need 10 crores. And can you give it to me? I said, यार बैंक में रखता तो 7.5% मिलते मेरे को. How much rate of interest are you willing to pay? That's the first question. Because in Mr. Mukesh Ambani's case, I am not even worried about the return of principal. right? So he says, I'll pay you 7.75%, 8%. I think, yeah, principal is anyway safe, and I'm getting half a point, matlab half percent more, so I can give it to Mr. Mukesh Ambani, right? So since there is very little additional risk, I am only expecting marginally higher return and I am safe. But if Rahul, what's the full name? Rahul Ramavat. If Rahul Ramavat comes and says, give me 10 crores, right? First question is, do ki nahi do, right? That's the first question I'll ask myself. Shall I give him 10 lakhs, 10 crores or not, right? पर से डर लगेगा नहीं, छोड़ा करिए भैया कि भाग गया. If I give you 10 crores, and if you decide to leave Sirmaur and disappear, what will I do? I'll keep filing a court case against him, but ज़्यादा कुछ क्या कर सकता हूँ, right? So there is a lot of risk involved in giving 10 crores to him. The first risk is whether he can even pay my interest on a timely basis, but a much bigger risk is whether he will return the principal or not, right? So I am assuming all of you have seen the movie Pushpa. नहीं देखा? सी में तो सबने देखा था. So anyways, let me give you a very small context. What has happened is, just before Pushpa, somebody came asking 25 lakhs is not sufficient, give me 50 lakhs. And they murdered him, right? They just murdered him. And then he comes that I also came to increase it from 25 lakhs to 50 lakhs only. And they were saying, uska haal dekha na? Bola, and then he says, yes, I saw what you did to him, he got murdered, but considering the risk, now I am asking that now I actually came for increasing it from 25 lakhs to 50 lakhs only, but considering that the risk is high, now I want 1 crore. Got it? So if the risk is high, the expected return is high. Are you getting the point? When you invest in a startup, you know that most of the startups fail. If you invest in the shares of any Tata Group company, Reliance, Infosys, you know that you have invested in blue chip companies. Prices may go up or down, but in the long term, the prices are expected to go up only in the long term. These are all the best companies of India. But when you invest in a startup, is it possible the startup itself may disappear within next 6 to 12 months? And if startup becomes a bankrupt and your money also goes down the drain, is it possible? You got the point? So if you invest in a startup, your risk is higher. From Reliance and Infosys, if you are getting 10, 12, 13% return, say, from a startup, are you okay with 10% return from a startup? कितना चाहिए? 20 से क्या होगा यार? Think of you invest in 3 companies in a startup. 2 companies will become bankrupt, let us say. For the 3rd company, there is some chance it may not become bankrupt. Are you getting what I am saying? So if you invest in 100, 95% of startups anyways fail. It's only the 5%. So for a startup, you need amazing returns, right? We don't really know. It will depend on the risk profile, right? This is all part of primarily your financial management class, but the basic concept is part of accounting also. So all of us know right now the Ola IPO is coming, right? And the first investors of Ola, do you know how much Ola IPO is priced at 72 to 76 rupees, right? The first investors of Ola, do you know how much they bought the shares for? 8 rupees. 8 rupees. I had the name, but it's in my WhatsApp message. क्या नाम था? Technia, some whatever that name was, which I mentioned in the previous class. And then, but one of the subsequent investors of Ola bought it at 113 rupees or something. So while the first investor will get 9 times return because the pricing is 72 to 76, but the subsequent investor will lose money. He bought it at 113, and while Bhavish will make something like 275 crores from the sale of his portion of the shares. So the point, the point was, higher the risk, actual return may vary. Actual return may vary, right? In some years, stock market on an average over 15 years, if you see, stock market has given 12 to 13% return. But in some years, stock market has given 50% return, and in some years it has given minus 20% return also. So actual return every year may vary, but the long term return over 15-20 years we see is 12 to 13% for stock market. So do you see the difference between actual return and expected return? Actual return is 12 to 13% over 20 years, but expected return, but actual return in a particular year can be plus 50%, but it can also be minus 20 or 30%. Do you see? Actual return can be plus 50 and minus 20 both, plus 25 minus 10, plus 10 plus 15, it can be anything. But when you invest in equity market or in stock market, you will expect more return, I am not saying you will actually get it, you will expect more return than a bank fixed deposit, because there is some risk involved. Na? For that extra risk, you want more return. अगर एकदम बैंक फिक्स डिपॉजिट में मान लो 50% रिटर्न आ रहा है, लेट अस से, विल एनीबडी गो टू स्टॉक मार्केट? मतलब यार घर बैठे 50% मिल रहा है. आर यू गेटिंग व्हाट आई एम सेइंग? If bank fixed deposit are offering 50% rate of interest, who will invest in stock market which is offering 30-40% rate? मतलब as it is, sitting at home while sleeping, I can earn 50% return. What is the need to even look at the stock market? You got what I am saying? So coming back, so coming to deferred expenditure. So you have taken, let us say I was stupid. I have given you that 10 crore, right? You spent 5 crores, you developed a product, a new technology in 1 crore rupees say. And now, but your technology is excellent, it's amazing, but nobody knows about your technology. You spend 5-6 crores in promotion, intense promotions and advertisements related to this technology. The benefit of this technology will be realized over next 3 years or 5 years, right? This 5 crores of intense advertisement and promotional expenses, the benefit will be realized, let's say, over 3 years, or 6 crore kar dete hain, 6 crore, yeah, benefit over 3 years. Will you consider it as the expenditure of that year only, or will you say that no, the benefit of this expenditure will be earned over the next 3 years, so I will not call it as a normal revenue, normal expenditure of advertisement and promotion, which I was, if it was a case of normal expenditure of advertisement, you put up a banner, the cost of banner was 10,000 rupees, you will just say ki theek hai, in this year let's show it as our advertisement and promotion expenses, close the topic. But this particular intense one time amazing promotional things that you did on various TV channels and all over the world, it cost you 6 crores. This particular one, will you expense it immediately, or will you say the benefit will be realized over a long term? So let's call it deferred revenue expenditures. Are you getting what I am saying? Right? So this particular case are those expenditures, the benefit like intense, it can be restructuring expenses, it can be there are other examples also, but in this example it will be deferred revenue expenditure, the advertisement and promotion, 6 crores, of which we will show, okay fine, the benefit is over 3 years. So in the current year we will only show 1/3, and the balance, so out of 6 crore in the current year we will show 2 crore as expenditure of, and the balance 4 crore will appear in our balance sheet. The balance 4 crore will appear in our balance sheet as what? Deferred revenue expenditure, right? So this part is done. So coming to liability,
Sir, what is the difference between deferred expenditure and prepaid expenditure?
Prepaid. It is first difference is the quantum of money. Quantum. Prepaid, you remember we talked about insurance, 12,000 rupees of insurance, right? So it's a small, we said since we paid for insurance over the full year, we will say 1,000, 12,000 was for full year. So every month we will show 1,000 as insurance expense in the profit and loss account, and the balance 11,000 will appear as prepaid expense. The quantum of money was small. Here we are talking of the nature of expenditure being more one time in nature. This was anyways, the cost was to be spread equally over 12 months. This is the cost will be spread over multiple years. The cost will be spread over multiple years, and the benefit will also be realized over multiple years. So you got the point? So this was only for 12 months, and it can very well be 24 months. At times you pay insurance policy for 24 months also. कि भाई मैंने 2 साल का एक साथ पेमेंट कर दिया है प्रीपेड. But you have understood the difference. So the nature is this is called deferred revenue expenditure, because these are more like one time in nature. These are normal business expenses. Insurance to every year will come, right? This is not happening every year for you, and the quantum is also big. So this is the asset side. On the liabilities side, we have the current liabilities. So notes payable you can mean as same as notes or bills receivable, the opposite of debt. So what is a bill of receivable for me is a bill payable for him. That's what we discussed, right? What is bill receivable for me? Bill of exchange, bills receivable is bills payable for him. Notes, in the US the term may mean something else, but in India we can say bills and notes are same for our purpose, for the purpose of this class. No point going into finer distinction, right? So for the purpose of this class, the beginners class, let's say it is the same. Accounts payable are opposite of accounts receivable or trade receivable. So the other name for accounts payable is sundry creditors. The other name for accounts payable is sundry creditors. What are accrued? You know that, so I don't have to explain. So when I bought from Raymond and Aditya Birla Group all the clothes, I have to pay to them, right? So so they are my creditors, or trade creditors, or accounts payable, or trade payable. So you can call it by various names. What is accrued liability? Today is 31st of July. My company has to pay salary to all the employees. Let us say the company policy is we don't pay salary on 31st of July of the month. We pay after the month is over on the next working day. So the salary will not be paid say on 31st of July, but on 1st of August. So when we prepare the accounts, when we say accounts, the financial statements for the month of July, will we show the salary expense for the month of July in the profit and loss account? Yes or no? Yes. But have we paid the salary?
No.
If salary was paid, cash would have gone out, but cash didn't go out. On the other hand, even if it is for a day, salaries are due to people. It should have been paid on 31st evening at least. So since it was not paid, and it will be paid now on 1st of August, therefore we have something called as an accrued liability, which is salaries due but not paid. So accrued liabilities, the other name is outstanding liabilities. So it can be called salaries payable, it can be called salaries due but not paid, it can be called outstanding salaries. So it's all the same, right? Income tax payable, similarly you owe this to government. It is a liability that you have to pay to government for the income tax. Bank overdraft. When you take loan from bank, you may go to bank for multiple reasons. Let us say we have this company where we need 100 crores now. We are short by 100 crores even after raising money through our IPO, or even after raising money from various sources, we still need 100 crores. So if we need 100 crores, क्या करें? Let's go to a bank for a long term loan, right? Why do we need 100 crores? we need 100 crores to set up a factory. We have to set up a new factory, we are expanding. So you go to bank saying this is our business plan. So when you go to bank for a loan, you have to come up with a business plan, something called as a business plan. What is it that you will do with the proposed funds? So you show a plan that, see, using this loan of 100 crores, we will set up a new factory, and this new factory will generate additional revenues. There will be additional expenses, but this is the yearly profit that I will make over the next 10 years. A business plan would normally be for a minimum period of, absolute minimum period of 5 years. In most cases, you will see at least for 10 years, at least 10 years. Yeah, 5 to 7 years is the absolute minimum, but 10 would be the normal case. And why don't we do more than 10 years here? Who has seen the future? Why don't we do more than 10 years? Because who has seen the future, right? So we go to a bank with the business plan and convince the bank manager that, see, we have such an amazing idea. We will need 100 crores to set up the factory, but don't worry, your money is safe because our business plan is so good. We will earn, using your 100 crores, we will earn at least 25 crores per annum, let us say. So we will first repay your interest every year, and over the next 10 years, we will gradually repay your principal also, right? So when you go for such purpose, this is a long term plan. So you will apply not for a short term loan, but a long term loan, that you give us 100 crores over for a 10-year period. So that will be a case of long term loan, which is separate from a short term loan. The short term loan from a bank is called a bank overdraft. The other name for it can be a working capital loan or a bridge loan. Why? Because the short term loan is taken to tide over temporary deficit of cash. The short term loan is taken to tide over temporary deficit of cash, which can be for a few months, maybe 3 months, 6 months, 9 months. So you take a small loan for a short period to, for example, you remember the concept of operating cycle. So at times we may suddenly find कि यार जेब में पैसे नहीं है. So the business, our monies are stuck in our inventories, our monies are stuck in our debtors. Somehow, because of whatever reasons, we were not able to sell enough, and even if we were able to sell, we have been able to only sell on credit. So there exist sales, but the monies will come after 3 months, 4 months, and monies are stuck somehow because of some reason. So if the monies are stuck, can you stop paying your employee's salary? Can you stop paying the general business expenses? Do you have to pay the electricity bill? Do you have to still pay to the landlord the rent? Are you getting what I am saying? Expenses continue. The incomes have dried up. So we know this, right? We have income tax payable, bank overdraft. So that is understood. And then what are debentures? Long term loans we already know. We have understood long term loans, right? The bank loan, long term loan. And debentures, let me come to it after explaining the share capital, right? When a company is formed, there are two fundamental documents involved in the formation of a company: Memorandum of Association and Articles of Association. Memorandum of Association is the charter document of the company, and memorandum has multiple clauses. One of the clauses of Memorandum Association is called as capital clause. Under capital clause, it will specify what is the maximum share capital of the company, how much it can issue. How much it can issue. Actual में issue करना जरूरी नहीं है. How much it can issue. So how much it can issue is the authorized share capital of the company. So let us assume for our hypothetical company, the authorized share capital is 1 lakh rupees. How much? 1 lakh. By how? 10,000 shares of 10 rupees each. So the authorized share capital is 1 lakh rupees. Now I need to issue, the maximum I can issue is 1 lakh. If I want to issue more than this, I have to first alter my Memorandum of Association. But let us say I don't even need 1 lakh at the moment, right? So when I form a company, even though my requirement is only 50,000 or 80,000, let us say, I'll still keep a higher figure under authorized just to take care of future eventualities also, right? But I actually want to issue only 8,000 shares. Okay, I know enough for me. 10,000 shares not needed. So I issue 8,000 shares of 10 each. That is called the issued share capital. Issued. I came up with an IPO of 8,000 shares of 10 each, say, yeah. Unfortunately for me, the IPO was not fully subscribed. The SEBI rules require that the IPO should be minimum subscribed for minimum 90% of the issue size. So 90% of issue size was how much? 72,000. 80,000 into 90%, so 72,000. Fortunately for me, I crossed that limit. How much was subscribed? 7,500 shares of 10 rupees each, so 75,000 is subscribed, right? And now I realize that I have got 75,000 rupees of subscribed capital, but I don't need the entire 10 rupee per share. I don't need the entire 10 rupee per share. At this stage, for next 1 or 2 years, the maximum that I need is say 45,000 rupees for next 2 years. उसके बाद में देखेंगे. So ऐसे कि बिना मतलब लोगों से पैसा लेके क्या मतलब है? What is the point of unnecessarily collecting monies from people? So we say कि at the time of application you only have to pay how much? 6 rupees per share. When you subscribe, you only have to pay 6 rupees per share. So I collect 45,000 rupees from the public, right? So this is called as my paid up capital. And why is it in red? It's in red because this is what will appear in the balance sheet. This is what will appear in the balance sheet. It will be mentioned in the balance sheet that authorized is this, issued is this much is subscribed, but this is the final figure that's actually written there in the balance sheet. Are you getting what I'm saying? So these are the types of, this is all part of equity capital, right? Share capital, right? There is one more type of capital, share capital. In addition to equity shares or common shares, we also have something called as preference shares. It's not written here, but we have something called as preference shares, right? The reason I said na, I'll come to debentures later, पहले इन पर आ जाते हैं, then we come to debentures. Preference shares, who are equity shareholders? Are they insiders or are they outsiders? Outsiders. They are insiders. And when outsiders are there, let us say debentures. Debentures are again instruments. We will come to debentures later, but let's stay to share first. So equity shares we have understood. Preference shares. Preference shares. What are preference shares?
They are paid for
Right.
at the time of
Yes, perfect. Amisha is right. Perfect. Thank you. So preference shares have two preferences over equity shares. How many preferences? Two. First, do you remember when we were talking, what was Rahul? What was your concern when you gave that 1 lakh to him? Did you have two concerns? What were the two concerns? One whether you will get your principal back or not. And what was the second concern was whether you will get your interest back on a timely basis. So when a person gives loan to somebody, that person has two concerns. One, whether I will get my principal back. Second, till the principal is repaid, whether I will get interest on a timely basis or not. That is the only two concerns possible. ठीक है? So of course you are concerned about how will he deploy my money, but that deployment is only linked to once he deploys it money productively, then you will get your principal and interest. That is the only reason you are concerned about how he will deploy the funds given by you, right? When you take money from your dad to start a business, he asks, कर क्या रहे हो? He asks, ना? So that's exactly the point, because he is concerned कि पैसा डुबा तो नहीं देगा, right? So that's any person who gives you money has those two concerns. मेरा principal आ जाएगा, whether I will get my interest or not. So, preference shares holders have two preferences. What is the first preference? In case of dividend, they will have preference. So, they will get dividend first, then the equity shareholders can be given dividend. So, if preference shareholders are not given dividend, then equity shareholders will also not be given dividend. The second is, if the company is liquidated, I am not saying the company will get liquidated. If the company is liquidated, then the preference shareholders have preference over the equity shareholders. कि ठीक है, first of all the outsiders must be paid. First of all the outsiders must be paid, and thereafter, after paying all the outsiders, something is still left. Even that something, first the preference shareholders will be paid, and then whatever is balance is the residual that we own as equity shareholders. You are clear? So, that's, it's not written here, but the other type of share capital is preference share capital, right. Now, preference shareholders are all partly insiders and partly outsiders. In that sense, they are technically insiders. So, they are almost standing at the gate. We are deep inside. They are almost like insiders, but standing at the gate. हमसे पहले, they are like, they have the characteristics of both insiders and outsiders. Technically, as shares or shareholders, they are insiders, right. But preference shareholders will get interest, not interest, dividend, preference dividend, which will be something like 8%, 9%, not more than that. While equity shareholders can technically get everything. You can get 20% dividend, 30% dividend, 50% dividend, but they have very little risk. They have, as you see it, they have very little risk, or their risk is higher than debenture holders who are outsiders, debentures पर आ रहे हैं, but lower than us who are equity shareholders, because if the money is lost, we lose everything. Preference shareholders will still be ahead of us in the queue. Preference shareholders will be ahead of us in the queue, right? So, now coming to, now we will come to debentures. Debentures are also instruments issued by the company, but these instruments are issued similar to shares. Shares are issued to insiders, debentures are issued to outsiders. But their characteristics is very similar to preference shares, except that preference shareholders are technically insiders. But debenture holders again have only two concerns. Primarily, they will have only two concerns: whether I will get my principal back, whether I will get interest, right. So, debenture holders will get interest of say 8-9%, something like that, and that debenture interest is also called as interest. Of course, it's also called as coupon or coupon rate, right. So, the coupon rate is 8%, 9%, 10%, something like that, and it can be paid on either 6 monthly basis in practice or 1 year annually. So, nobody pays quarterly, yeah. So, and then we have below that we see two types of reserves: capital reserves and reserves in surplus. Ola's IPO, the share is valued at 10 rupees. The book value or the face value of the share is 10 rupees, but they are issuing it at what, 72 to 76, let us say 75, just for the sake of ease. The book value or the face value of the share is 10 rupees, but they are issuing it to the public at 75 rupees per share. And interestingly enough, even in the, forget earlier years, even in the last 3 years, they are all still in losses. So, it is surprising, na? We pay 100 rupees on an average, 30 to 35 rupees is taken by Ola, the balance goes to the driver, and still they are in losses. Are you seeing how much it takes to start a business? But we also know that there is a bright future, because Ola and Uber jointly, broadly, have captured the taxi market, right, in all the bigger cities at least. And so, the future is bright. Everyone uses Ola or Uber these days. So, when they are issuing shares at 10 rupees, or not at 10 rupees, of book value 10 rupees or face value 10 rupees, but they are issuing it at 75 rupees, right? So what is this balance 65 rupees? It is called a share premium. Are you getting it? So they are issuing a 10 rupee share at 75 rupees. So this difference of 75 minus 10 represents share premium of 65 rupees. So when a company issues share premium, on one share they are collecting 65 rupees extra. On lakhs and lakhs of shares they are collecting crores of rupees, right? Let us say they have a share premium, let us say of 500 crores, let us say. This 500 crores of share premium, extra money collected, on the debit side it is reflected in cash, cash aa gaya, and on this side it will still assets equal to liabilities plus equity, right? The accounting equation must balance. 75 rupees, 10 is allocated towards share capital being the face value of shares. So that is going under equity share capital 10. The balance 65, where is it going? It is going into something called as share premium account, which is part of capital reserves. Is this 65 rupees per share the normal business income of Ola? Is Ola in the business of issuing shares and earning profits on issuing shares? No, that is not the business. What is the business? Running taxis, effectively, right? They are an app, lots of people sitting in their offices and working, and what are they essentially doing? They are providing taxi services to people. That is what they are doing. So this is not the normal business income of Ola. It is not the normal business income of Ola. So if it is not the normal business income of Ola, will it go under retained earnings? So within retained earnings, I agree it won't go to the retained earnings, that normal business operations, but it will enter into a separate account called capital reserves, where it will appear as share premium. We are all clear on that? The same balance sheet, previous one was in horizontal format. On one side we had assets, on one side we had liabilities and capital. This is the same thing, but in vertical format. So first we have equity and liabilities, so shareholders funds, non-current liabilities and current liabilities. Do you see that? It is one side that we saw. Right now we had formed it in a T. We said in the previous case we saw it was a horizontal format, it was in a T format, one side assets, one side liabilities and equity. Now it is a vertical format. So this is the first part, and because it can't all come in one sheet, so in the next sheet we have shown, but it is continued. It's continued. Are you getting it? It's not two separate pages, it's one page, but just so that it is visible properly, we have broken down that one page into two slides. So this is the equity and liabilities part, second is the assets part, but it's one after the other. It's not two separate pages, it's one page shown as two slides. Are you clear on that? We already know current assets long term. Next. Yeah, this is important. The same asset can be classified either as a fixed asset or as a inventory. If you are in the business of selling cars, then car is your fixed asset or car is your inventory? No, both किसने बोला? Why both?
Because there will be some cars which will be for test drives.
No. To test drive, still you sell them eventually at a lower price. Cars for test drive, so don't give him 10 crores. He doesn't, his concepts are weak. Cars for test drive are inventory. You just sell them at a lower price. You might have seen advertisement, Mercedes brand new, only used for test drive, 2000 kilometers.
So even the showrooms sells it off.
They will give a discount of 2 lakh rupees, 3 lakh rupees. They will say ki the reason it's 2000 kilometers is only it was used for test drive, that's it. For last 6 months you have been using. So they will give you 5-10% discount. You will also think ki chalo le lo yaar, 10% discount mil raha hai. In a 50 lakh car you will get 45 lakhs, 40 lakhs, that kind of discount. So you will happily buy it, right? So Both was for a different reason. So you saw both and you said both. So, for if you are in the business of selling cars, then car is your inventory. But what if you have a car for the general manager of the company? You have an office car for the managing director of the company. All those are also your assets and they are your fixed assets, because you are not in the business of selling the managing director's car or the general manager's car. Are you getting that? So, that is the reason in such a case. So, it will then depend on the use, right. I am not, because I have already explained every single item already. So, I am not going through the. So, what are readily marketable securities? We saw one of the categories after cash. Invest in readily marketable securities such as bank term deposits, liquid funds, shares, debentures, forex and government securities, and then you sell them. Bills receivable arise out of credit sales and negotiable instruments which are called bills of exchange. So, these are, as I have said, these can either be bills receivable when you receive that money. So, these are promise to pay. I agree to pay the bearer of this note, for example. It can be a negotiable instrument which can be endorsed. If I have written I promise to pay Mehak or the bearer 2000 rupees after 2 months. So, one, she can come after 2 months, but she can also endorse it to her Vasudha ki tum le lo. Then she will come to me with that note, and then your liability with her is discharged, but she will come to me after 2 months saying, here is the note, give me money. Inventory we already know, it can either be a manufacturing firm or a trading firm. It can either be a manufacturing firm or a trading firm. In manufacturing firm, we will have raw material, work in progress and finished goods. In a trading business, we will only have stock or inventory. Yeah, this part I have not mentioned. So, the value of the assets at cost is usually referred as gross block. Gross block, the other name is gross fixed assets or gross block. Then we say less accumulated depreciation. So, gross block is the value of the car that we bought, the 10 lakh car, do you remember? So, gross block, if we have the only one asset, we will say gross block 10 lakhs, then we will have every year depreciation 1 lakh, accumulated depreciation will be 1 lakh in year 1, 2 lakh in year 2, 3 lakh in year 3 accumulated and so on. So, gross block minus accumulated depreciation gives you net block, that is the other name for assets, right. So, fixed assets will be shown as net fixed assets or net block. So, gross block means gross fixed assets less accumulated depreciation equal to net block or net fixed assets. Land is not depreciated, we know. Intangible assets we have already covered. What was the example given in the last class for intangible assets? हाँ, मेरे पास यार क्या है, ये कोई आंसर बोलो, मेरे पास माँ है, अमिताभ शशि कपूर की तरह बोलो, राइट. What was the answer given? मेरे पास गाड़ी है, बंगला है, बैंक बैलेंस है, फैक्ट्री है, गोडाउन है, तेरे पास क्या है? Right? मेरे पास माँ है, right? That is what we said, right? So, do you remember that? So, and we said for fixed assets we say depreciation. For intangible assets, what's the name? Equivalent of depreciation? Amortization, right? So, intangible assets are amortized over a long period of time or a short period of time? Now, how many say long? Okay. And how many say short? बाकियों का क्या है? Not sure. No. We had, if you had, अरे यार इनके तो lecture, that means you are not reading the slide. Slide was already put and the slide clearly said, and I clearly remember saying, it is done relatively in a short period of time. Do you remember I also gave the example, you have come up with a new patent or intellectual property right, and then I said you think the benefit will last over 40 years, but 2 years later or 3 years later somebody comes up with a new technology, the entire effort goes down the drain. So, you amortize intangible assets at within a short period of time. Do you remember that? It was specifically mentioned in this slide. Investments are carried at cost. So, investments can either be current investments that you invest money for and that you intend to convert into cash within a year, or they can be long term investments which you intend to for years together, right? The same investment, the same thing, it only depends on intention. You bought 100 shares of Reliance, you intend to sell it in 10 days, it is a marketable security. You bought 100 shares of Reliance, your intention is I will hold it for next 10 years, I will hold it for years together, it is a long term investment. So, whether it is a short term or a long term investment depends on your intention, right. You are free to classify it either as a short term investment or as a long term. Short term investments are called marketable securities or current investments. What it? So, it all depends on your intention. Of course, current are readily realizable. They can of course be realized readily, but the intention is to hold them. Achanak, your business meets with an emergency. Emergency aa gaya. You need urgently 3 lakh rupees. Your intention was to hold the Reliance shares for long term, but there is an urgent need of funds for you, you have no choice but to sell Reliance, right. Even though it was a long term investment, you say, yeah, because of urgent business need we had to sell it. We approached bank said no, in order to process I need the loan, I need 10 days. मेरे को तो 2 दिन बाद पैसा देना है किसी को. I sold my long term. So, it is not the period of holding, it is your intention. Of course, it is a period of holding also, you got it, but you can sell it earlier also. This is important. Sometimes business entities prepare their tax and adjust it in later years like prepaid expenses. Then deferred expenditure are considered expenses in the normal course of business that lead to a reduction in the owner's equity. Look at this, expenses such as restructuring expenses, advertisement like intense advertisement expenses, intense promotion costs are deferred. Normally, you put up a poster, it cost you 500 rupees, you just put it in the expense for that year. But when you run an intense TV ad, chain of TV advertisements, cost you 50 crores. For a small business, for Mr. Mukesh Ambani, it is also ठीक है, expenditure for the year में करो खत्म, right? For it depends on who you are, right? Are you getting what I am saying? On the facts, but for a small business of yours, you how much you have 10 crores, you spent 5 crores on advertisement, promotion cost for the new product that you have developed. For you that 5 crores, the benefit will be only for this year or it will be last for several years. So, in that case it becomes something called as a deferred revenue expenditure. Are you getting it? So, and many firms, the other name for these expenditure can be miscellaneous expenses, to the extent not written off or adjusted. There is another word added to it, miscellaneous expenses, to the extent not written off or adjusted, and to the extent that they are not written off, they are appearing in the balance sheet. To the extent that they are written off, where are they? For that particular year, profit and loss account, or for previous years, already written off and out of the system. Contingent liabilities. Contingent liabilities do not appear in balance sheet, they appear as footnotes to the balance sheet. Contingent liabilities. What are contingent liabilities? Contingent liabilities are liabilities for which it is not certain that they are your liabilities in the first place. Since there is no certainty, both has to, there are two types of certainty. One is whether it will become a liability or not, and second is if it becomes a liability, what will be the value of that liability. You are fighting a court case, chances are you might lose, chances are you might win. If you lose, you have to pay to him, you are fighting against him. What's your name? Vishwal. Vishwa, and you are Anurag.
Yes.
So, Anurag's company is fighting a court case against Vishwa, against Vishwa, right? Against Vishwa, you might win, you might lose. Today is say 31st of March, you are closing your book, the court case is still on. Do you have a liability or do you not have a liability? The point is, we do not know. At this stage, we really do not know. 3 months later, the court decision comes. If we lose, we will show it as a liability. If we do not, if we win, there is no liability. So, it can be shown as part of footnote to the balance sheet. You got it? So, at least disclose. And why is it shown as part of footnote? At least let us be fair to our investors. An investor has a right to know what are the possible future liabilities that the company may incur. An investor, I am trying to invest in your shares. If you had told me that he is suing you for 10 crore rupees and your capital is 5 crores, and I think there is a 50-50 chance, then there is a 50% chance your company will sink. If I know that his company may sink and there is a 50% chance, I will not invest a penny. So, that is the reason for disclosure purpose you still have to disclose it. Ki, no, this guy is suing me for 10 crore rupees, and if he becomes successful, then the company may sink, right. So, we need to know what are the potential risks before I invest in the shares of a company. We need to know what are the potential risks that we face, right. There are two types of long term liabilities, secured and unsecured. At times a bank will give you a loan just like that, but very often in life, how many of you have applied for a home loan till date? Has anyone ever bought a home loan, or anyone see your parents apply for a home loan? What was happening? The bank gave you a loan, but the bank said give me the original papers, original title of the flat or the land, give it to me, right? Give it to me. Why? Then you can't sell it. If the original papers are lying with the bank, you can't sell it. If the flat that you buy is worth 1 crore, they will say okay fine, you only invest 20 lakhs, we will provide you 80 lakhs. They will say you only provide 20 lakhs, we will provide you 80 lakhs, right? And why is that? Because even if the value of the home falls by 20%, their money is still safe. If you fail to pay installments, they will very soon start giving notice to you that now you pay, otherwise we might sell the property. Either you pay or we will sell the property and recover our loan. Are you getting that? So, when a bank has given you a loan which is backed by some security, in this case the original papers of the home are lying with the bank, right. So, it is called a secured loan. It is called a secured loan. Why? Because apne to safe hain, we are safe. If needed, I can sell his flat and recover my money. So, I am not at risk, right. But if you do not have any security or any asset backing your loan, then it is called as an unsecured loan, right. So, these are the two types of liabilities. Reserves and surplus we have already mentioned. From business operations, from non-business operations, revenue reserves versus capital reserves, I just explained, right. So, revenue reserves are free for dividend distribution, capital reserves cannot be utilized for dividend distribution. So, now see, this part we will not do in great detail. We are managers, but only because it is mentioned in the syllabus, I have to cover it. So, on day 1, I have already mentioned it on day 1. I have already mentioned it on day 1, but at that time you did not understand. We said what is the sequence of steps in recording and reporting transactions? First is the documentation of the transaction, right. So, if you buy a car, you will have an invoice, you will also have a bank statement which shows the money has gone out, right. So, all these things are the transaction documentation. The next step is to pass a journal entry. You know, till now we have done transaction analysis, we have always seen an asset is going up. When one asset goes up, there are how many possibilities exist? 3 possibilities. From our accounting equation, assets equal to liabilities plus equity, one asset has gone up, assuming it is a simple entry, not a compound entry. What are the 3 possibilities of other change? One asset will go down, bolte raho. One liability goes up, equity goes up, right, because the accounting equation must balance. So, this is the double entry aspect of accounting, ki it is not that in a balance इन ऑर्डर टू बैलेंस, ऐसा नहीं हो कि एक बार ये चला गया और बैलेंस हो गया, बैलेंस तो नहीं हुआ. सो समथिंग हैज़ टू गो डाउन तब बराबर हो गया, और समथिंग हैज़ टू गो अप तब जाके बराबर होगा, राइट. सो जर्नल एंट्री, we will see what are journal entries. Once we pass the journal entry, in the third step we prepare the ledger accounts. We prepare the ledger accounts, and after preparing the ledger accounts, we prepare the trial balance. We will see what it is, and finally we prepare the financial statements. What are the financial statements? Profit and loss account, balance sheet, and cash flow statement, right. Is everyone mentally clear on the process? Process should be clear in your mind. Step 2 क्या है? Journal. After preparing journal entries, what step 3? Ledger. After ledger, what step 4? Trial balance. And after that, what's the final step? Assets equal to liabilities plus equity, we already know from day 1. Assets equal to liabilities plus equity had paid in capital or paid up capital plus retained earnings. Assets equal to liabilities plus equity. So, assets are written on this side, liabilities and equity are written on that side. Are you getting it? Now, note it. Assets debit is rise. So, assets are debit, increase in assets is debit, and decrease in assets is credit. For everything else, reverse. Simple. Assets are debit, increase in assets are debit, decrease in assets are credit. So, the moment you see increase in cash, if asset is debit and increase in asset is debit, is increase in cash debit or credit? Debit, right. And ulta, they are on the two different sides, but so liabilities will therefore are credit, because assets का उल्टा हो जाएगा. Liabilities are credit, increase in liabilities are credit, decrease in liabilities are debit. Paid up capital are credit, increase is credit, decrease is debit. Retained earnings are credit, retained earnings are credit, increase in retained earnings are credit, decrease are debit. Now, retained earnings had two more parts, if you remember. What were the two parts of retained earnings? Expenses and revenues. When revenues rose, when revenues went up, did retained earnings go up or down? Up. So, revenues and retained earnings are moving in the same direction. Revenues and retained earnings are moving in the same direction. So, revenues are credit. What is the ulta of revenues? Expenses. When expenses rose, retained earnings were moving up or down? Down. So, revenues are moving in the same direction as retained earnings, expenses are moving in the opposite direction. Are you getting that? So, expenses, if revenues increase in revenues is credit, retained earnings is credit, then increase in expenses is what? Debit, it is moving in the opposite direction. Are we clear? Digest. This is all you have to remember. This is all you have to remember. Assets are debit, increase in assets are debit, decrease in assets are credit. Then you draw the accounting equation, and assets are on one side, liabilities and equity are on the other side. So, ulta of assets are liabilities and equity, and then under retained earnings, revenues and retained earnings move in the same direction. So, retained earnings and revenues will have the same thing, and expenses are opposite of revenues, therefore, they have. So, in one slide we have learnt all the rules of accounting. Congratulations, right? Okay, debits and credits are done. So, now you know how to do it. So, that is the double entry system of bookkeeping, right? So, once we have posted, so the double entry system is very simple. Once we have posted, let us say, let us take that example only that we just solved in class. We said cash received, accounts receivable went down, right? So, we said asset is debit. So, increase in asset is debit, cash is an asset. So, cash account is debited, right? Let us say 5,000 rupees. Increase in asset, पिछली slide में चले जाओ. Increase in asset is debit, right? And decrease in asset is what? Credit. So, in the example that we just saw in the exercise, we said cash account received 5,000, to accounts receivable, right? I am just writing short. AR means accounts receivable. So this is credited. I am just writing credited, right? 2 means कि credit कर दिया है 5,000. Are we all clear on this part? So this is how we pass journal entries. Asset is debit, increase in asset is debit, and decrease in asset is credit. So we already know how to analyze transactions. So if you know that the impact of this transaction is cash went up, cash is an asset, cash went up, increase in asset is debit, so cash account is debited. Accounts receivable went down, how much? 5,000. Accounts receivable is an asset, decrease in accounts receivable is credit, decrease is credit, right? This is all you need to know for accounting passing debits and credits. That's it. That's how we have learned, and this is it. So cash account is debited and accounts receivable is credited. That's how you pass journal entries. Are we all clear?
Yes, sir.
Right? The account which is debited, cash account debited, and then the account which is credited, you write 2. That's it. Right? There's a more detailed format coming up, but this is the essence, right? Essence yahi hai. Then you have to write dates. You know, you have to write kaun si date thi as 31st of July. So of course you have to write 31st of July, right? Right? And then you have to pass a narration also, something called as a narration. Being cash received from accounts receivable, you will name that accounts receivable person. So who gave you that money? Vasudha gave you that, right? Huh? So being cash received from accounts receivable, Vasudha, right? So you just name the person or Vasudha's account. Are you clear? So having received it, having passed the journal entry, what is the ledger account then? Ledger account is again very simple. So ledger account is a T account. What is it? It is a T account. How does it look like? So cash account you prepare. So cash account will be, and again every account has a debit side and a credit side. Every account has a debit side. So this is the, for assets, this is the debit side, this is the credit side. Even liabilities, this is the T account. If you take it as a T account, this is the debit side, this is the credit side. This is the debit side, credit side. So cash account going up. So if this is the cash account, we will write cash account. On the debit side, we will write 5,000 rupees. Are you getting what I am saying? And there he will write 2 accounts, date weight to likhe denge, 2 accounts receivable, right? 2 AR 5,000. And then we will show an accounts receivable account. Accounts receivable. So we have a debit side and a credit side. What was the entry? Cash account debited to accounts receivable. So account receivable, it will appear, this is the right side, left side is debit, right side is credit. So accounts receivable, first we will write the date 31/7, then we will write by cash, to and by, and how much? 5,000. Are we clear how it's to be done? And then finally, after passing all the journal entries, you will balance the accounts. You know how to balance the accounts? So simple hai, that's just like Taraju wala balancing hai. If one side we have already balanced, if you remember, in the previous session we have balanced the profit and loss account. Every time we said revenues 3,000, expenses 1,000, then we said gross profit 2,000. Then we took the gross profit here 2,000 on this side. Then against that we wrote some other expenses, say interest, right? And then we said again EBIT is this much. And we wrote not EBIT, we wrote not interest but other expenses. Hi, this is Dr. P. Sanjay, and I am a professor at Indian Institute of Management, IIM in Sirmaur. If you like my videos, please feel free to subscribe to my YouTube channel. Thank you.